And we want just, those are the topics under number 1, assets and liabilities. And we just want to go straight to the first item, which is impairment of assets, impairment of assets, that is IAS 36. We already mentioned when we say IAS, what do we mean? We already mentioned that. We already mentioned when we say IAS, that is International Accounting Standard number 36. I already said that IAS we have from IAS 1 to IAS 41. Therefore, some have been repealed. To repeal means they have been revised and replaced with other versions of standards. Therefore, we have IAS 36 there. The provisions of impairment, we get them there. Therefore, impairment of assets. Now, what is impairment? That is the big question tonight. What is impairment? Now, sometimes I know when I ask you what is impairment, you will tell me that it is the loss of value of an asset, Definitely, you will tell me that impairment is the loss of value of an asset. Loss of value of an asset. That is very correct, but it's not as correct as I as Mwalimu expect you to say. Impairment, now we have these 3 terms before we go far. We have these 3 terms. We have depreciation, we have amortization, and we have impairment, Listen very carefully here. These 3 terms, we have depreciation, amortization, and we have impairment. Now, when we talk of depreciation, it is also the loss of value of an asset. When we talk of amortization, it is the loss of value of an asset. When we talk of impairment, it is the loss of value of an asset. But now the big question is, where is the difference? Where is the difference between these 3 terms? Now, when we talk of depreciation, it is the loss of value of an asset over time through wear and tear. Loss of value of an asset over time through wear and tear. Like, for example, you purchase your motor vehicle today. Today is, I think, 15th of January. You purchase the motor vehicle. You start using this motor vehicle. Come in Easter, when you do the exams, you will find that your motor vehicle is depreciated because you are using it. It is not as it is today. That is depreciation. You check on the fiscal outlook of this motor vehicle. You just say that this is depreciated. But amortization is the loss of value of an intangible asset. Examples of intangible asset include patents, includes copyrights, includes franchise, includes trademarks. Therefore, it's the loss of value, but attributed to an intangible asset that has no physical substance. Then when we come to impairment, let me give you a scenario here. You can purchase your phone. Let me say my good friend Ruth has purchased the motor vehicle. My good friend Ruth has purchased the motor vehicle. And when you purchase this motor vehicle, a phone, let me say phone, you purchase it at 80,000, 80K. You purchase today this phone, 80K. Now, after some few hours, let me attribute it to few hours, you go to the where you purchase the phone, they tell you that now the phone has come to 60K, 60,000. The phone has come to 60K. Remember, it is the same day you purchase that phone. What does it mean, my good friend? If I purchase the phone today and the same day, the phone has come down, the market price has come down, the difference between the much I purchased and what is now retaining of that phone is what we call impairment. The phone is now impaired. The phone is now impaired. Like now, when we say you are visually impaired, it means you are not able to see. You are visually impaired, you are not able to see. Therefore, impairment is the loss. Now we can define impairment. We say impairment is the loss of value of an asset. Impairment is the loss of value of an asset so that the recoverable amount is less than the carrying amount in the balance sheet. Therefore, impairment is the loss of value of an asset so that the recoverable amount is less than the carrying amount in the balance sheet. The loss of value of an asset so that the recoverable amount is less than the carrying amount in the balance sheet. Recoverable amount is less than the carrying amount in the balance sheet. Like I said, you purchase your phone at 80K. When you go back to the market today, it is at 60K. Therefore, if you want to sell this phone, my good friend Waziri, if you want to sell this phone, can you sell it at 80 or you sell it at 60? In fact, you will sell it below 60 because the market price is 60 and you have to remember it's already purchased. Therefore, it has already lost some value there. Therefore, here, when I say the carrying amount, what I have in the balance sheet, the amount I'm reporting in the balance sheet of 80K, that is the carrying amount. Then the recoverable amount is what I can recover on sale of that phone. Therefore, my impairment loss equals to carrying amount minus recoverable amount. Carrying amount minus recoverable amount. Therefore, the carrying amount of an asset is 80K, but when I want to sell this asset, I can only recover 60K. Remember, the asset is still new. Therefore, that difference is what we call impairment. That's why we are saying impairment is the loss of value of an asset. Remember now, so that the recoverable amount, what I'm recovering from that asset is less. I'm repeating the word, is less than the carrying amount in the balance sheet. Is less than the carrying amount in the balance sheet. Now the question comes for us to understand impairment very well, for us to understand that definition very well, we need to know what is the carrying amount of an asset. Carrying amount of an asset. Now, when we talk of the carrying amount of an asset, we mean it is the book value, or the net book value, NBV, the net book value. That is the carrying amount of an asset. But in the definition, we say carrying amount or the book value is the amount of an asset or liability. Amount of an asset or liability reported in the balance sheet. Reported in the balance sheet at the end of the period, at the end of the year, or at the end of the period. The carrying amount of an asset is the amount of an asset or liability that is reported in the balance sheet at the end of the year. For example, I purchase a motor vehicle, the cost of motor vehicle equals to 200 million. 200 million is the cost of motor vehicle. This motor vehicle is depreciated. When I depreciate the motor vehicle, depreciation may be equals to 200 times 10%. Therefore, depreciation is 20. 10% is 20 there. Therefore, at the end of the year, when I want to report this motor vehicle in the books, I will take 200 minus 20, I get 180. Therefore, at the end of the year, or at the end of the period, I'm going to report 180. 180. Therefore, 180 becomes the book value, becomes the carrying amount of that asset. Therefore, we are saying that impairment is the loss of value of an asset so that the recoverable amount is less than the carrying amount, less than the book value, less than the book value there, less than the book value or the carrying amount. Now I have defined the carrying amount of an asset as the amount that is reported in the balance sheet at the end of the year, at the end of the year. Therefore, that is the carrying amount. Then another question comes, what is the recoverable amount of an asset? In a layman's language, recoverable amount is the amount you are going to receive, for example, on sale of the asset, the amount you are going to recover from that asset. If, for example, I want to sell that asset, how much am I receiving from there? That becomes what? The recoverable amount. But according to the standard IAS 36, let's define the recoverable amount. The recoverable amount, we shall be abbreviating RA. RA means the recoverable amount of an asset is the amount that is higher of, amount that is higher of, amount that is higher of. Recoverable amount is the amount that is higher of. Number A, the assets, fair value less cost to sell. Assets fair value less cost to sell. Less cost to sell, assets fair value, less cost to sell, assets fair value, less cost to sell. Number B, the value in use or present value. That is the definition of recoverable amount. Remember, in a layman's language, I'm saying the amount that you can receive on sale of an asset, for example. Therefore, that is a recoverable amount. But according to the standard, it is not only the sale of the asset that you can get the recoverable amount. Sometimes you can use what we call the present value. You discount the cash flows from the asset, then you get what we call the recoverable amount. Therefore, what we are saying here that recoverable amount is the amount of the asset or liability that is higher of. That is higher of. Number A, the assets fair value less cost to sell. Then number B, the value in use of the present value. Like for example here, when you check here, my name is writing something here. Fair value of the asset is 200 million. Then present value of this asset is 300 million. Fair value is 200 million. Recoverable amount is 300 million. Now I want my good friend Florence Accord, my good friend Florence Accord, to tell us, according to this definition of the recoverable amount Marimu has given us, what a value here will qualify to be the recoverable amount. I have two values there, fair value and the present value. Which value there will qualify to be the recoverable amount of this asset A? Which value there? Quickly there. Which value will qualify? This is specifically for Florence. Which value will qualify there to be the recoverable amount? Thank you very much, Ruth. You have decided to come in A. Thank you very much. 300. 300. Why is it 300? Because the definition says recoverable amount of an asset is the amount that is higher. The amount that is higher of, number A, the asset fair value less cost to sell. Number B, the value in use of that asset. The higher of, thank you very much, the higher of, which is 300 here. Therefore, a recoverable amount, the examiner can ask you if for 2 marks or 3 marks. Explain the meaning of the following terms. Recoverable amount. That is the amount of an asset that is the higher of. Number A, assets fair value, less cost to sell. Number B, the value in use, the value in use. Now, let's develop this concept as we move on. We need to understand when we say asset fair value, less cost to sell, what does it mean? When we say assets fair value, less cost to sell, less cost to sell. Now, when we talk of assets fair value, less cost to sell, it means like this, my good friend, you need to listen. It means fair value, less cost to sell, it is the amount that you receive on sale of an asset in the market. Florence, you say quiz. I think you are saying quiz. If you have a question, you don't ask permission, you just put it in the chat. Mwalimu will see and will respond. If, for example, you have a quiz, like my good friends, you say Q-E-N. I have a question. Yes, Florence, go ahead. You don't ask permission in this class. You just put it in the chat. Mwalimu will see it and respond. Therefore, when you have a question or a concern, don't ask permission. Just put it in the chat. That is the easiest way to communicate. Thank you very much. You can now go ahead, Florence, or you want to just speak. Maybe you can unmute. I have not muted you. You can unmute and ask if you so wish, or you can put it in the chat. Please explain for me the following, the value use. Thank you. Go ahead.
Yeah, good evening, Mwalimu.
The value in use.
Yes, the value in use and the present value. Because you see the example that you've given out, one, the fair value of 200 million, then the present value of asset 300 million.
Now
then
that is where
stated
I was headed to.
Yes, that the
that
recovery amount.
I'm heading to. I want to explain the meaning of these two terms: the asset fair value, less cost to sell, and the value in use, or the present what value. That is where I'm headed. That's why I'm cleaning the board here. Therefore, thank you for that. Now let's continue. Now I was saying. Now listen very carefully here. When we say number A, assets fair value, less cost to sell, what do we mean? Fair value less cost to sell. Assets fair value less cost to sell. What do we mean when we say fair value? Because here I'm saying we are going to compare between two figures, the asset fair value and the value in use or present value. Therefore, when we say number N, assets fair value less cost to sell, what does it mean? Now it means assets fair value less cost to, or let's say, start by defining the word fair value. Fair value is the amount that you obtain on sale of an asset in the market. Fair value is the amount you receive on sale of the asset in the market. That is the fair value, the amount you receive on sale of the asset in the market. But now, for example, my good friend Florence there, you want to sell your laptop, for example. You want to sell your laptop, a very good laptop, HP. You want to sell it. But now, because you are not an expert in marketing, you call Mwalimu here and say, Mwalimu, I have a laptop that I want to sell. Can you get a customer for me? Therefore, Mwalimu goes ahead and get a customer for you to sell a laptop. Then you sell a laptop at 100K. Therefore, if you are going to sell that laptop at 100K, you have agreed at 100K becomes the fair value of that laptop, because you have agreed with the buyer that you are going to take 100. Therefore, that becomes the fair value, the market value. Now, but remember, you did not get that customer for yourself. It is Mwalimu who connected you. Therefore, you are going to give Mwalimu a commission of 5K. You are going to give Mwalimu a commission of 5K. Therefore, if you are going to give Mwalimu a commission, therefore we say that how much have you recovered from that laptop? You have only recovered 95K. You have recovered 95K. Therefore, in your books, my good friend Florence, you will not report 100K, but you will report 95K because you paid a commission, you paid brokerage fee or commission or advertisement fee, you paid out. Therefore, when we say the asset fair value less cost to sell, you check how much can this asset sell in the market. You can sell at 100, but out of that 100, you are going to subtract any cost that you are incurring before you sell. Any cost like advertisement, transportation, blah, 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 those costs. You subtract, that's why we are saying the asset fair value, less cost to sell. Then we come to number B now, the value in use or the present value. Now, it's not only, listen very carefully now here, my good friend Florence, it's not only the market value can give you the value of the asset. It's not only the market value. Also, we have what we call the present value. Now, present value means I'm going to project, for example, I have an asset. I have an asset, and I project that this asset, for example, in year 1, it can give me maybe 1,000 in year 1. In year 2, it gives me 2,000. In year 3, it gives me 3,000, for example, cash. The cash flow I'm getting from this asset. Therefore, if I want to know the value of this asset today, if I want to know the value of this asset, I will have to discount these cash flows. I discount these cash flows to get what we call present value. You discount the cash flows to get what we call the exact value today. Exact value. When you say present value, is the exact value of the asset as at now. And now the value in use means the value that is available to use in that asset. Like, for example, today, our laptop here, how much cash that is available in it. Therefore, the value in use, it means how much is available in that asset. Therefore, for us to get it, we are going to discount the cash flows. Like we have the formulas of discounting. If it is a lump sum, you use the formula 1 plus R raised to negative N. I believe you are an FM experts. You can see this 1 plus R raised to negative N. You discount, or if it is annuity, you use 1 minus into bracket 1 plus R raised to negative N. The whole thing you divide by R. You divide by R. The whole thing you divide by R. The formulas for discounting, so that I get now. And what am I going to discount? I'm going to discount the cash flows to get the present value. Now the question comes, examiner can trick you. If you want to discount, listen very carefully. If you want to discount the cash flow to get the value of an asset or the present value, there are 3 cash flows that can arise in that asset to discount. There are 3 cash flows. Number 1 cash flow, we call it, number 1, the cash inflow or the cash generated by the asset. For example, here, I project that in year 1, the asset will project 1,000. I will generate 1,000, sorry. In year 2, the asset will generate 2,000. In year 3, the asset will generate 3,000. Therefore, this is the cash inflow I'm getting from this asset. I can discount it to get the value of the asset today. Number 2 cash flow I can discount, listen very carefully. Number 2 cash flows I can discount is the disposal value of the asset at the end of its useful life. For example, I purchased the asset today, 2024, and for example, I will sell this, the useful life of the asset is 5 years. The useful life is 5 years. Therefore, in 5 years' time, I will be selling what? I will be disposing of this asset. How much will I be disposing of? Like, for example, I will be disposing it off at 5 million. 5 million at the end of the useful life of 5 years. Therefore, if I want to know the present value of this asset, what will I do? I will discount this. I will discount this 5 million, the disposal value in 5 years' time, to get what we call the present value. To get the present value. Number 3, type of cash flow you are required to discount if it's available is the cash outflow that you incur in the generating the cash inflow. Like here, for example, for me to get this cash inflow, 1,000, 2,000, 3,000, maybe there are some cash I'm incurring so that I can generate this cash inflow. There are some cash I'm incurring. Therefore, those cash you are incurring is also cash available to discount. You discount also that cash so that you get the present value. Therefore, there are 3 types of cash flows examiner can test for you to get the present value. Number 1, the cash generated by the asset. Number 2, the cash you can get on disposal of the asset at the end of the useful life. Number 3, the cash that you incur in the generating the cash inflow. The cash you are paying for you to generate cash inflow. You also discount it to get the present value, And my good friends, I know this one you can forget, but I believe you will not forget. The cash flow you are required to discount should be what we call pre-tax cash flows. Pre-tax cash flows means it is cash flow before tax. Before you subject it to taxation, that is when you do what? When you discount. That is when you discount. Like for example, let me show you something here, something small here. For example, examiner has given you cash from an asset, cash flow from an asset. Maybe the cash flow is 2,000. Then tax is 200. Therefore, when you less, you are going to get 1,800 after tax, cash flow after tax. Therefore, if examiner has given you such a cash flows, the cash flow I'm going to discount is not this one. It is 2,000. I discount 2,000. That's why I'm saying pre-tax cash flow. Before you pay tax, you discount those cash flows. Before you pay tax, you discount those cash flows. Any question so far?
Yes, there is. It is well understood. I've understood up to that part of pre-tax. That is okay. Now,
yes.
I'm asking a question. The 3 types of cash flows that we have, it is cash inflows generated by the assets.
Yes.
We have the other one for disposal value.
Yes.
And the third one is cash outflows. So I'm asking, these cash outflows, it is generated from?
Now, the cash outflows, like, let me give you the example of this one. What is on the board? Now, as you can see, the tax is the cash outflow. Like here, the tax is what? I'm required to pay out of 2,000, I'm required to pay 200 as cash outflow. Because if I'm paying, definitely it becomes a cash outflow. Therefore, out of this 2,000, I'm required to pay tax. But when I want to discount, I will discount before I pay tax, which means I have also discounted the cash outflow. I have also discounted the cash that I'm supposed to pay out. Therefore, that's why I'm saying, if you have any cash and there are some expenses that you are required to subtract, you discount before you subtract those expenses. You discount this one before you subtract the expenses. Because those cash you need to pay out, that's what we call cash outflow. That you will need to pay out is also part of your cash you discount to get the present value. Therefore, this is the best example here. Any cash that you are required to pay out is part of your cash you discount. Thank you very much. You say you understood. Thank you very much. Therefore, an examiner can ask you, like he asked in the 2022 somewhere, the cash that you are required to discount or to determine present value. We have cash inflows, cash on disposal, and the cash outflows that we incur in the generating of cash inflows. Therefore, that is what we need to understand. Therefore, we have said that impairment loss is the loss of value of an asset so that the recoverable amount is less than the carrying amount. We now know that the carrying amount is the book value of an asset, the amount that we report in the balance sheet at the end of the year. Then the recoverable amount, this is the amount that is higher of number A, the asset's fair value and the value in use or the present value. That is what we have discussed, and it's very important for the purpose of this topic. For the purpose of this topic. Now, what we are saying here is that if I want to get impairment loss equals to carrying amount minus recoverable amount. Therefore, here, for example, my carrying amount is 2,000, recoverable amount is 180. Then definitely 20 is my impairment loss. 20 is my impairment loss because the recoverable amount is less. But in a scenario where the carrying amount is 200, recoverable amount is 250, then here it means impairment is nil. Why? Because the recoverable amount is more than the carrying amount, the asset is gaining more value. The asset is gaining more value because impairment is a loss. Therefore, we don't have any loss there. We are gaining. Now, listen to this, is also very important. Impairment loss is an expense. Impairment loss is an expense, and therefore should be written off, should be charged to the P and L, should be charged to the P and L, should be charged to P and L as an expense, should be charged to P and L as an expense. Therefore, you are going to debit P and L as an expense. Then you credit asset account. You credit asset, it will reduce the value of our asset. Therefore, we know that impairment loss is an expense and therefore should be charged to P and L profit or loss statement as an expense, which means in accounting language, we debit P and L, then we credit the asset account. We credit the asset account there. Therefore, that is what we call impairment. That is what we call impairment. Now, the question can come now. Let's assume my good friend, Daniel. We have good friend Daniel there. Daniel. Now you are the CFO or the chief accountant of your company. Then at the end of the year, you want to prepare your financial statements. Then the directors task you that kindly give us impairment this year. Give us impairment. Therefore, if you are tasked, for example, to give impairment, where will you begin, my good friend Daniel? Where will you begin? How will you start to give us impairment in the company? Remember, you are the chief accountant of the company, then you are required to give us impairment. Where will you start? Where will you start? So that you give us impairment, where will you start? Utaanzia wapi so that you give us impairment? Let me see. You can just unmute and tell us, or you can put it in the chat. That's a good question. You can put it in the chat, or you can just unmute and tell us. Where will you start? Where will you start? Now, we say here, criteria of identifying potentially impaired assets. How will you know that your asset is impaired? Criteria of identifying a potentially impaired what? Asset. How will you know that your asset is potentially impaired? Number one, they fall in the market value. They fall in the market value of the asset. They fall significant fall in the market value of the asset. Significant fall in the market value of the asset. Significant fall in the market value of the asset. Now, for example, if you want to identify impairment, my good friend Daniel, you are going to see in your asset register, you check your assets, you find it is 200 million. That is according to your asset register, 200 million, according to the book value. Then you call the property valuer. Of course, because you are not an expert, you will not value the asset yourself. Therefore, you are going to call the property valuer. When the property valuer comes, he tells you that the value of your asset should be 180, for example, according to the current value and everything. The market value should be 180. Therefore, as you can see, the market value has come down. Therefore, we are saying the fall in the market value. Therefore, the market value has come down to 180. Therefore, according to IAS 36, you are required to reduce this value of the asset to 180. You are going to reduce it. Therefore, you to reduce, it means in your P&L, you are going to take there 20,000. 20 million there in your P&L because it's a loss you are incurring for the asset. Therefore, you take a loss of 20 million to the P&L. Therefore, a fall in the assets market value. Number two is significant change, significant change in the technological, legal, and economic environment, economic environment in which the asset is employed. Significant change in the technological, legal, or market environment in which the asset is employed. The asset is employed. Significant change in the technological, legal, or economic environment in which the asset is employed. Like, for example, change in technology. Like when mobile phone came in Kenya, we were having the Mulikamwisi phones, But now technology has changed. When you see Mwalimu with the Mulikamwisi phone, then you start imagining. Now, what is the status of this Mwalimu? Because he only has the Mulikamwisi. It means that because technology has changed, you cannot expect somebody to have a Mulikamwisi. Therefore, if you find anybody with a Mulikamwisi, then you start imagining the life of that person. You create him, you create that person. Therefore, changing technology will, of course, impair the asset because even if, for example, you bought a Mulikamwisi at 30,000, if you want to sell it today, because of changing technology, you cannot even recover 10,000 there. You cannot even recover 5,000. You cannot even recover 1,000. A person will tell you that, let me give you 200 or 500 at most, 500. Therefore, you find that because technology has changed, nobody is interested in that Mulikamwisi. Therefore, technology will impair your asset. Number three, increase in the interest rate. Increase in the interest rate or market rate of return. Market rate of return on investment. Increase in the interest rate or market rate of return on investment. Return on investment. Therefore, why am I saying increase in the interest rate or market rate of return on investment? Remember, I said for us to get the recoverable amount of an asset, listen very carefully, you are going to discount the cash flow to get what we call the present value. For me to discount the cash flows, I'm going to use the interest rate. Therefore, if the interest rate goes up, like for example, the interest is 10%, it goes to 15%. Then it means at 10%, we have high present value. When it goes to 15%, present value goes down. It becomes lower. Therefore, it goes down. Therefore, if I'm using, for example, the present value as my recoverable amount, then it means that the recoverable amount will be less by the interest rate, by the virtue of interest rate going up. Therefore, increase in the interest rate in the market will impair your assets because if you are using the present value to determine your recoverable amount, then of course the recoverable amount will be less. Recoverable amount will be less. Therefore, increase in the interest rate. Then number four is a decrease in market capitalization of the company due to decrease in price per share, decrease in the market capitalization of the company due to decrease in the market price per share. Remember, when we talk of impairment, it's not only the computer, it's not only the motor vehicle, it's not only your chair in the house. But sometimes, remember, when we talk of impairment, even the company itself can be impaired. The company itself can be impaired by virtue of the value going down. The virtue of the value going what? Down. Like, for example, maybe you have 2,000 shares in your company, 2,000 shares. For me to get the market capitalization, you are going to take the number of shares times the price per share. Therefore, let me say the price per share is 200. Therefore, my market capitalization is 400,000. Market capitalization is 400,000. If I have 2,000 shares, the price as at now is 200. Therefore, my market value of the company is 400,000. Now, supposedly, I still have this, but the market value comes to 150. The market value comes to 150. Therefore, it means that if the market value comes to 150, then the value will be 300. The value will be 300. Therefore, my company is reporting a loss. That is what we call impairment. The company is reporting a loss by virtue of my price per share going down. Therefore, the market capitalization is decreasing. The market value is decreasing. Therefore, we are reporting what? Impairment. We are reporting impairment. Then number 5, we have what we call physical damage. Physical damage, of course, if your asset, your motor vehicle is damaged, then of course you cannot recover the value. If you want to sell it, somebody will just flash you off that this motor vehicle I cannot buy at 500. Maybe you give me at 200. But remember, maybe you just purchased it recently. Therefore, it will impair your asset, physical damage. Then number 6 is reduction in production. Reduction in production. For example, in your company, using your machine, you are producing 1,000 units in a day. You are producing 1,000 units in a day. But today, even if you do whatever, you cannot even produce 600 units in a day. You cannot produce 600 units. Then what does it mean? It means that your asset is now towards its end. It's impaired. Therefore, reduction in production will just show you that your asset is impaired. Then lastly, number 7, decision to halt construction. Decision to halt construction of an asset before completion. Decision to halt construction of an asset before completion. Decision to halt construction of an asset before completion. Like, for example, you are putting up a building. After some stage, then you stop that project. Now, the moment you are stopping, and remember, at this stage, this asset is not giving you any economic benefits because you have not completed it. Therefore, it means if you have invested there 50 million, that 50 million is impaired because the asset is bringing nothing. But remember, for you have invested 50 million there and you have stopped construction. Therefore, it will automatically be impaired. That's why you are seeing in the government affordable housing, the president is trying as much as he can to complete the project. Because if he stops today, remember we have invested like 50 billion in that project. Now, if the court will stop that project, then you will find that whatever we have put there is impaired because we are not getting anything from that project. Therefore, that's why now the president is trying as much as he can to make sure that the project is completed. That's why you are seeing there is court to do what blah 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 blah, because the president wants to complete that project so that it cannot become a white elephant which is impaired. Therefore, decision to halt construction of an asset before completion will impair that asset. Those are some of the factors that will indicate that the asset is potentially impaired. It will show us that the asset is impaired. Therefore, now we know how we can identify the asset is impaired. Now, if you are the chief finance officer of your company, if you are the senior accountant in your company, make sure that you advise your company on how to report what? Impairment, on how to report impairment each year, on how to report impairment each year. Make sure that you advise your company that this year, let's report some impairment. Let's report some impairment because it is also good when you report such expenses, it reduces on your tax obligation. It reduces on your tax obligation. Okay, that is how we can know that the asset is impaired. Any question up to that point, kindly make sure you are free to ask questions. As we said in our first class, never postpone understanding. Never postpone, never assume anything that after this I will read and understand. No, we are in a live stream. Therefore, make sure that you get the point as it comes. Make sure that you get it as it comes so that you don't have to postpone any understanding of the concept. Therefore, that is what we have to discuss there. Now we know what is impairment. Now the remaining part is, let's do a question and see if we can do impairment. Let's do a question and see. Waziri, I missed the impairment last, depreciation and amortization differentiation. We said that depreciation is the loss of value of an asset over time through wear and tear, wear and tear, or physical deterioration, the loss of value of an asset through wear and tear, physical deterioration. Then amortization is the loss of value of an intangible asset, or the standard would say the allocation of costs, allocation of costs to an intangible asset, allocation of costs to an intangible asset, that is amortization, or the loss of value of an intangible asset. That is what you are requesting. Now I believe you are okay. Now let's look at one or two questions there so that we move on with this good concept. We are starting with two questions. We are doing the question of, let's start with ACAST 2022, question number, I think 2. Then we look at the question of November 2020, question number 1C. Question number 1C. I posted the handout, the question papers on our WhatsApp. Therefore, I believe you will look at it. I'm opening, that's why I said you print like Marimo has the hard copy. Therefore, I can easily go there. ACAST 2022, question number 2A. ACAST 2022, question number 2A. We look at the question on impairment briefly. I kindly go to that question and make sure going forward, you maintain it. You can save in your Google Drive, or you can save it somewhere, or you can print it, so that when Marim says, let's go to the past paper, you just, like Marim is just opening comfortably. If I want to revise, I will just take, I revise any sitting I want, any sitting I want like this very comfortably. Therefore, if you have 2 coins, like 200 shillings, you can just print and comfortably revise. Remember, AFR is about revising. Let nobody deceive you. AFR is about revising. You internalize the concept, you revise on it. Then when you do the exam, you will find, because examiner will just repeat questions. Examiner exhausted questions many time, a long time ago. Therefore, now it's just repeat. Therefore, if you do as many questions as possible, you will find that when you go to an exam, you are just doing the question that you are doing the other day. It is the same the question that you are doing the other day. Therefore, I'm encouraging you to have these papers available at any time. We shall be doing it frequently because this will be our reference point. KASNEB questions will be our reference point. I will not be coming with any question. Remember, KASNEB has enough questions on each topic. Therefore, I will not be bothering myself to come with extra questions. And like now here, we can do as even 10 questions on impairment here. There are as many as possible. Therefore, if you are there, you say yes. If you are there, ACAS 2022, you say yes so that we proceed. Mwalimu cannot do the question to himself. He must have a quorum of people who have the same. Therefore, make sure if you have, you just say why in the chat. If you are there, you just say yes. It's good, Mwalimu, to know if my people are there or not. Just check on our WhatsApp, open that, then we go to ACAS. Thank you very much, Daniel. You are already there. 2020 or 20. Let's start with 2022, Ruth. Let's start with 2022. 2022, ACAS 2022, question 2A. Then we come to November 2020, question 1C. And then we come to that. Thank you very much. You are there, Waziri. Thank you very much. Thank you very much. Jen, thank you very much. You are already there, Jen. Thank you very much. Thank you very much. And what I urge you is that you are required to be consistent in class. Kindly make sure that you are consistent in class, because whatever we are doing is what the examiner will test. Therefore, if you miss some concepts, then it will become a problem to you. Therefore, make sure that you are consistent in class, you follow on every stream, so that we discuss and we see what you are required to do. Then we also add some little revision. Then you will find that AFR is the easiest topic so far. But if you don't revise, if you ignore, it will become a problem. Now, let's look at this question of 2022. Let's look at this question of 2022. It says like this: B Limited operates a factory as its sole cash generating unit, CGU. During the year ended 30th April 2022, there was an explosion in the factory which necessitated the impairment review. The carrying amount of the factory assets were as follows. We have goodwill, patents, machinery, computer equipment, then premises. Additional information. An impairment review revealed a net selling price of 19,200,000 and a value in use of that 1,200,000 for the factory. Half of the machinery have been destroyed and have no resale value. Number 3, the patents have been superseded and are now considered worthless. Number 4, the company follows the cost model as permitted by International Accounting Standard IS 16 property, plant and equipment. Required, discuss with suitable calculation how any impairment loss in the cash generating unit CGU will be accounted for in accordance with the International Accounting Standard IS 36 impairment of assets. Now, examiner here is saying, using computations, can you account for the impairment? Using computations, can we account for impairment? The question of ACAS 2022. Now here, we said that, let's begin with ACAS 2022. We said that impairment equals to carrying amount minus recoverable amount. Carrying amount minus recoverable amount. Carrying amount minus recoverable amount. That is impairment. Therefore, in a question like this one, if the examiner wants impairment, then I will ask myself, do I have the carrying amount, the book value? Like when you check in this question, examiner has given us the carrying amount of all the assets. Carrying amount equals to 47,600. Total is 47,600. I believe you can see it. Examiner is wishing us success. He has already given us the carrying amount. Then also in note number 1, examiner is saying an impairment review revealed net selling price of 19,200 and value in use of that 1,200 for the factory. Therefore, I come to the recoverable amount. Now, examiner is also giving me recoverable amount there. What is the fair value? The fair value equals to 19. If I want to sell this asset, I can sell it at 19,200. 19,200 there. Then value in use or the present value. Value in use or the present value. Examiner is giving me that 200. That is what the examiner is giving me as the present value. Therefore, if I want the recoverable amount, my good friends, I'm going to choose the higher of, because the recoverable amount is the higher of, the amount that is higher of the two. The amount that is higher of the two. Therefore, from your common sense, you will just tell Mwalimu that the recoverable amount of this asset equals to 31,200. That 1,200. Then, if it is that 1,200, then impairment equals to, I will take 47,600 minus that 1,200. Who is a good student there? To give Mwalimu impairment loss. To give Mwalimu impairment loss. Who is a good student? Make sure that you give the answer before your neighbor. You give, that is the spirit of AFR. You make sure you utilize your calculator very well. You give the answer before your neighbor. Before somebody else types, you have already typed your answer there. That is the spirit of AFR, and you will find that AFR is enjoyable if you participate. Thank you very much, Ruth. You say 16,400. Therefore, impairment is 16,400. Impairment is 16,400. Impairment is 16,400. That is what the examiner wants as impairment. But now, in this question, because examiner will give you 10 marks, examiner will want you to allocate this impairment to the cash generating units. Examiner will want you to allocate impairment. This 16,200, up to here, you have 4 marks. You have 4 marks up to here. Remember, this question wants 10 marks. But up to here, when you give me impairment like this, you are going to get 4. You are going to get 4 marks. But have you gotten 10? No. Now, what the examiner wanted there, he wanted you to allocate that impairment. Let me show you how you are going to allocate impairment. Already we have 16. How are you going to allocate it? How are you going to allocate it so that you give us the new carrying amount? How are you going to allocate it so that you give us the new carrying amount? The new carrying amount. Then for me to allocate this impairment, I'm going to say carrying amount. I'm putting columns here. Carrying amount before impairment, carrying amount before impairment. Then I report impairment. Then carrying amount after impairment. I want to allocate that impairment of 16 to H cash generating unit. Listen very well here, because Marim is introducing another concept there. Now, my carrying amount, here I have goodwill. My goodwill has the value of 2,000. Goodwill has the value of 2,000 there. I have what we call patents. Patents has the value of 3,600. I have what we call machinery. Machinery have the value of 4,000. But now on machinery, let's put machinery 1 and machinery 2. I will show you machinery 2. Machinery 2. Let's put 1 and 2. I want to show you something there. Machinery 1 and 2. So that examiner in note number, listen very carefully. In note number 2, examiner is saying half of the machinery have been destroyed and have no resale value. When you take machinery, it is 4,000. Therefore, half is 200, 2,000, half is 2,000. Therefore, machinery 1 is 2,000, which is fully impaired. Then machinery 2 is 2,000. I will show you something there. I just want you to separate like that so that note number 2 will be useful to us. Note number 2 will be useful to us. Then we have computer. We have computer. Computer is 8,000. Computer is 8,000. Then we also have premises. Premises is 30,000. 30,000, so that it gives us 47,600. You can see 47,600. You can see 47,600. Machinery I have separated because of note number 2. Half of the machinery is impaired. Therefore, I will explain why I'm separating there. Just follow the instruction there. You will understand very well. You will understand very well. Now, my impairment total. My total impairment is 16,400. 16,400. My total impairment is 16,400. Now, what the examiner wanted you to do, examiner from this asset, he wants you to allocate the impairment of this to each cash generating unit. Now, listen, my good friend Florence, listen very carefully. If you want to allocate impairment on cash generating units or on assets, and you have goodwill, like here, we have goodwill. Remember, you allocate full impairment on that goodwill. You allocate full impairment on that goodwill. If you want to allocate impairment on any assets, and in those assets, there is goodwill, you fully impair the goodwill. Therefore, here, I have impairment of 16,400. I want to allocate to my assets. Therefore, I will first allocate to goodwill. Goodwill, 2,000. So that the carrying amount is now nil. It means in my end balance sheet, I will not have goodwill because I have allocated full impairment. All this loss has gone to goodwill. I have fully impaired what? Goodwill. Therefore, there will be no value after impairment. Then examiner tells us that in note number 3, note number 3, examiner says the patents have been superseded and now considered worthless. Therefore, there is no value in patents. Therefore, here I also impair it completely. It is fully impaired. It's fully impaired 3,600 because it's worthless. There will be no value at the end. There will be no value. It is worthless. Therefore, I put a dash. I will not have value after impairment because it is worthless. Therefore, can you put a worthless asset in the balance sheet? Of course, you cannot. Therefore, that one, we are removing it in the balance sheet. Then we go to the machinery. Examiner is saying that machinery, half of the machinery is worthless, has no value. Therefore, that one, we are going to impair it completely. We have no value. But now the rest, the balance is good. The balance is good. Therefore, it will have the value. The balance is good. It will have the value. Listen very carefully. The balance is good. Therefore, it will have the value. Then note number 4 says the company follows the cost model. Now, out of this, it means that from the examiner's point of view, this asset, this is total impairment that we have seen. Total impairment that we have seen. Total impairment from this asset. But remember, our impairment total is 16,400. Therefore, this one will be 2,000 plus 3,600 plus 2,000, which is giving me 76. 76. That is impairment that I have seen. Now, out of 16,400, I have minus 76, I have 88. The impairment that is remaining unallocated is 88. Now, this impairment that is remaining unallocated, I'm going to allocate to these good assets. I'm going to report to these good assets. Why? Because we said when you have impairment, you debit P and L, you credit asset, you credit asset, you credit asset, you debit P and L, you credit asset. Therefore, we have impairment that we have not allocated to the asset of 8,800. Therefore, this 8,800, I'm going to allocate to this good asset that I have in the company so that I reduce, I debit P and L, I credit asset, I credit asset. Therefore, how am I going to allocate the balance of impairment? How am I going to allocate the balance of impairment? You allocate on pro rata basis. You allocate on pro rata basis. How am I going to allocate? Let me show you. Let me show you. Let me show you how I'm going to allocate. Let me show you how I'm going to do what? To allocate. Let me show you how you are going to allocate. Now, this one, it means that I'm going to take the value of this good assets, which is 2,000 plus 8,000 plus 30,000. I get 40,000. 40,000. Now, if I want to allocate to this good asset impairment, I will take 2,000 over 40,000 total times 88 times 8,800. Then I get how much of impairment I'm going to allocate to this good machine. I want a good student to give me that. When you take 2,000 over 40, 40 is the cumulative value of these good assets that we have not impaired. Who can give us the impairment? 2,000 over 40 times 88. Quickly, I said you need to give an answer before your neighbor. Thank you very much, Ruth. There we are allocating 440. Therefore, this 440, it is going to machinery that is good, 440. Now, this 440, it means at the end of the period, I will have the value of machinery to as 1560. 1560 because I'm taking 2,000 minus impairment of 440. At the end, I will have 1560 there. If you subtract, you get 1560 there. 2,000 minus 440, that is 1560. Then I also allocate to computer. Computer, I will take 8,000 divided by 40,000 times 88. Times 88. How much? You need to give an answer before your neighbor. Don't just leave for Ruth to give us answers. Kindly make sure that you participate fully in class. 1760. Thank you very much, Ruth. 1760. Now, at the end, I will take 8,000 minus 1760. How much do I get? 8,000 minus 1760. How much do I get? There. Make sure that everybody participates in class. Kindly be quick. Make sure that everybody participates. Don't just leave for one person. Edwin, can you respond something there?
Mwalimu, I have a question.
Thank you very much. Not quitting, you say 6240. 6240. At the end, 6240. Then we also allocate to premises, which is 30,000.
Mwalimu, I have a question.
Yes, just ask. Just ask.
You have left me very much behind.
Yes, your voice is down. I cannot hear you properly.
Did you get the 8,800?
Where did I get 8,800?
Yes.
Thank you very much. Now, as you can see, according to the examiner, he told us that patents are worthless. Therefore, it's fully already impaired. Are we together there?
Yeah.
Then when we come to the machinery, he told us that half of the machinery is worthless. Therefore, it is fully impaired. Half. Are we together there?
Yes.
Are we together there? When examiner told us that half of the machinery is fully is worthless, not number 2. Are we together? Therefore, in a nutshell, 88, I'm taking total impairment minus this 3 because I said when you want to allocate impairment, first you impair goodwill. First, you impair goodwill. When you have impairment you want to allocate, first you impair goodwill. Then we allocated fully to goodwill. Then, because the examiner says that patent is worthless, therefore we also impair the patent. Then machinery is 2,000. Therefore, these two will give us 76. Now, when I take the remaining, because these are good assets, and if you have impairment, you allocate to good assets. You allocate to your assets on pro rata basis. Therefore, I took 16,400 minus 76. I got 76 is between these 3 figures. I got 88. Therefore, here we are allocating that 88 to these good assets. That's why we are seeing me allocating them. Therefore, 30,000 over 40 times 88. How much do we get? How much do we get? 30,000 over 40 times 88. 6,600. Thereby, I put here 6,600. 6,600, I put it there, 6,600. Then 30,000 minus 6,600, I believe it comes to, is it 23,400? Is it 23,400? 23,400, if I'm not wrong. If I'm 23,400. Now, if I add this total impairment, I'm required to get 16,400. That is the impairment that we received, 16,400. Then if I add this, when you add this carrying amount after impairment, how much are you getting? How much are you getting? 39, you get 39, that is 1560. 1560 plus 6240 plus 23,400. How much are you getting when you add 1560 plus 6240 plus 23,400? 31,200. 31,200. Therefore, this is the carrying amount, the value in use of this asset, the value in use. As you can see, even in the question, examiner told us that in note number 1, the value in use is 31,200. The value in use is 31,200. Therefore, this is what we are naming as our present value. The value that we have available for use is this one, what the examiner has given us. But the challenge was on allocation. The challenge was on allocation, but I believe it's not now a challenge. How did you get carrying amount? How did you get carrying amount? This carrying amount of 47 was given. Carrying amount was given as 47,600 of the asset. The carrying amount of the factory amounts as follows: 47. This total is 47. Then at the end, after we subject it to impairment, we are getting, you add 1560, 6240, then 23,400. We get that 1,200. I mean, after impairment. After impairment, Florence, I'm saying we are adding. You add this value because this one is fully impaired. There is no value. There is no value. There is no value. there is only 1560 because we subjected to impairment, 6240 because we subjected to impairment, 23,400 because we subjected to impairment. Therefore, after impairment, I have 1560, 6240, 23. When you add, just take the calculator and add, you will find progress that you get that one what? 200, and that is what the examiner gave us, that the value in use or the present value is that 200. Therefore, that is what we have there as our impairment. This is what the examiner wanted to give you 10 marks. But if you just gave us the impairment, like what we did, you only get 4 marks. You only get 4 marks. But now, examiner wanted the part of allocation. And in summary, I have said this in summary. I have said this. If you have, let me show you the scenario here. Let me show you the scenario here. Let me show you the scenario here so that you understand the allocation. Now, I have assets. I have assets, goodwill, 1,000. I have plant or machinery, 4,000. I have building, let me say 5,000. Total comes to 10,000. That is total. Then examiner gives me impairment of, let me say, 2,000, impairment of 2,000. That is the impairment. Then examiner wants me to allocate that impairment. Listen very carefully, I'm showing you the allocation of impairment. Examiner wants me to allocate impairment. This is my impairment. Although it's fictitious, don't ask Malim, why are you getting 2,000? It's just fictitious to make you understand this concept. Now, I have impairment of 2,000. I want to allocate to these assets. Listen very carefully. I want to allocate to those assets. Now, if I have goodwill in my NCGU, cash generating unit, first I impair that. Therefore, I will take impairment here, I will subtract, I will allocate 1,000 on goodwill, so that the value of goodwill is nothing there, it's a dash. I will no longer have goodwill. Then the balance, because I have subtracted their goodwill of 1,000, I'm remaining with 1,000. This 1,000, I come and allocate to this good assets. Therefore, to allocate, you allocate on pro rata basis. On plant, it will be 4,000 over 9,000 times 1,000. I allocate it there. Then on building, it will be 5,000 over 9,000 times 1,000. First, you will bear the goodwill. Like we did here. Remember, examiner did not say anything on goodwill. But once you have goodwill in your assets, first you subject it to impairment fully. You fully impair that goodwill, like what I'm showing you here. Therefore, when you want to allocate impairment, make sure that you do away with the goodwill, the value of goodwill, then the balance, you subject it to pro rata basis, you prorate on the assets. That is about that question. We want to go to the question number 2. Or before we go to the question number 2, let me give you some 2 minutes. You take some water. Then we go to question number 2 of November 2020. Just 2 minutes to take some water, kindly. 2 minutes, take some water. Then we go to November 2020. We do November 2020. Then it will be okay. I believe you are understanding the concept of impairment very well. I believe you are understanding the concept. So when we come back after 2 minutes, we are going to November 2020, question number 1C. As you take some water, you also open that question. 1. Let's go to November 2020, question number 1. It says like this. FPC Limited owns a machine which originally cost 10 million. The accumulated depreciation associated with the machine was 2.5 million. as at that 1st December 2020. A mechanical engineer assessed the machine in early January 2020. The engineer's report stated that similar damaged machine had sold for 1 million in the recent past. In addition, due to the machine's unique nature, significant advertising cost of 100,000 will be incurred to find the buyer. The machine was not covered by insurance. A power surge during the year ended that 1st December 2019 reduced the machine's production capacity and shortened its expected life. APC Limited's management accountant estimated that the damaged machine will generate cash flows of 3 million per annum over an expected remaining useful life of 3 years. APC Limited's cost of capital is 9%. No impairment of the machine had been recorded in the accounts. Required. In the context of IAS 36 impairment of assets, outline the necessary accounting treatment of the machine given the above information. Note, the present value interest factor of an annuity of Sh1 per year at 9% for 3 years is 2.5313. Therefore, examiner wants us to report impairment. Therefore, you start by giving us the formula. Impairment equals to carrying amount minus recoverable amount. That is the first step you do. Carrying amount minus recoverable amount. Carrying amount minus recoverable amount. Therefore, we ask ourselves, carrying amount is how much? When you check in this question, carrying amount is the book value. Therefore, examiner is telling us that the cost is 10 million. Therefore, I will take 10 million minus 2,500. Then I get 75 as my book value, as my carrying amount. I get that as my carrying amount. I get 75 as my carrying amount. Then I have the carrying amount. Then I come to the recoverable amount. Recoverable amount, we say that this is the amount. This is the higher of number A, fair value, number B, present value. Present value. I come to A, fair value, B, present value. Therefore, I ask myself, for me to get the recoverable amount, I'm going to compare the two figures. Therefore, in my question, do I have the fair value? Do I have the present value? When you read in that note, it says, a mechanical engineer assessed the machine in early January 2020. The engineer's report stated that similar damaged machine had sold for 1 million. Therefore, if I want to sell this machine, fair value is 1 million. 1 million. That is the fair value if I want to sell it, is 1 million. In the recent past, in addition, due to the machine's unique nature, significant advertising cost of 100,000 is required. Therefore, for me to sell this asset, I need to advertise at 100. Therefore, my fair value less cost to sell is 900. 900 is the fair value less cost to sell. Less cost to sell. Therefore, I have fair value less cost to sell. Then I ask myself, is there any fair value or present value? I go to the question. A power surge during the year ended that 1st December 2019 reduced the machine's production capacity and shortened its expected useful life. APC Limited management accountant estimated that the damaged machine would generate cash flows of 3 million per annum over the expected remaining useful life of 3 years. Therefore, for me to get the present value, I'm going to discount the cash flow. Discount cash flow. I discount cash flow. This is annuity. If I want to discount annuity, I will take 3 million into 1 minus into 1 plus r raised to negative n divided by R, of which my 1 minus into 1 plus 0.09 raised to negative 3 divided by 0.09. That is 9%. You take 3,000, you multiply, but the examiner is very gracious in this question. This one already examiner gave us 2.5313. Examiner already gave us in note the present value of interest factor 3 years is 2.5313. Therefore, examiner has already given me. Therefore, I will just take 3,000. But if the examiner has not given you, you use this formula. You use this formula to get it. You use that formula to get it. How many knows how to use that formula? Because we cannot just assume. Maybe somebody somewhere does not know how to apply that formula. Kindly, if you don't know, you just say, I don't know. On your calculator, you take 1 plus 0.9, it will be 1.09. Then on your calculator, there's something that they raise there. Something raised there. You press raise, negative 3. You press raise, then minus 3. You press that. Then you say 1 minus answer. 1 minus answer. 1 minus answer. You say 1 minus answer that you got here. You say 1 because 1 minus that answer. After you say 1 minus answer on your calculator, then again you say answer divided by, you take the answer divided by 0.09. You take the answer divided by 0.09. I believe when you do that, you get 2.5313. You get 2.1. Therefore, don't assume that you know, maybe you just practice. If it is a problem, you just tell us and we help you. Therefore, this will be 3,000 times 2.5313. 2.35. How much do we get there? When you multiply, how much do you get? 7594. Thank you very much, Ruth. 7594. Therefore, that is the present value. Therefore, between the fair value and the present value, which one will be our recoverable amount? Between 75 and 900. Which one is the recoverable amount? Which one is the recoverable amount? The recoverable amount, of course, is the higher, which is 7594. Therefore, here, my impairment equals to, I will take 75,000 minus 7594. Of course, it is nil. Of course, it is what? Nil. Of course, it is nil. Impairment is nil. That is what the examiner wanted to give you, that marks. That is what the examiner wanted to give you, the marks. That is impairment in accordance with IAS 36. IAS 36. Impairment according to IAS 36. Now, we are also required to discuss impairment under IPSAS 21. Under IPSAS 21, we are required to discuss impairment under IPSAS 21. Impairment of non-cash generating assets. Therefore, our next agenda is impairment of non-cash generating assets. Our next agenda is impairment of non-cash generating asset. Impairment of non-cash generating asset. Now, whatever we were discussing there was impairment of assets under IAS 36, which is impairment of cash generating asset. Impairment of cash generating asset, that is private company. This is IPSAS. IPSAS means International Public Sector Accounting Standard. International Public Sector Accounting Standard, IPSAS 21. IPSAS 21. IPSAS 21. Impairment of non-cash generating assets, IPSAS 21. Now, remember, in the public sector or in the private sector, the only difference that we are going to find in impairment is how to get the present value. Because in IPSAS, there is no cash flow that you can discount. Therefore, how do you get the present value under IPSAS? How do you get the present value under IPSAS? That is our next agenda, but because of time, I cannot introduce that, because if I introduce it, it will mean that in our next class, we shall repeat again before we catch up. Therefore, in our next class, we are going to begin impairment of non-cash generating asset, IPSAS 21. Therefore, that marks the end of our today's class, because it's only remaining some few minutes. It's only remaining some few minutes. You can stop. You can finish the course outline. The course outline. Now, in our course outline, topic number 3 was preparation of financial statement for other entities. This one, number 1, we have financial statements for banks. IAS 30, financial statement for banks. Number 2, financial statement for insurance company. IFRS 4. Then number 3, we have interim financial statements, IAS 34. Then number 4, we have interim financial statements. We have number 4, financial statements complying with IFRS for SME. SME means small and medium enterprises. Then number 5, lastly, we have financial statements in a hyperinflationary economy. IAS 29. That is our topic number 3. Then we go to topic number 4. Topic number 4 will be group accounts. Group accounts, including group cash flows. Including group cash flows. Then topic number 5 is accounting for in public sector accounting. In public sector accounting, Mwalimu, what is topic number 2? And I cannot go back to everything kindly. Remember something we were doing there for those who are there will post it for you, Florence, topic 1 and 2. Those who are there will post it for you. Topic number 5 is public sector accounting. Public sector accounting. When we talk of public sector accounting, here we are going to talk of number one. Number one is segment impairment. Number one is impairment. Impairment of non-cash generating assets. Non-cash generating assets. Non-cash generating assets. That is what we are writing here now. Impairment of non-cash generating assets. Impairment of non-cash generating assets there. Number two, under public sector, segmental reporting. Segmental reporting. Number three is related party disclosures. Related party disclosures. Related party disclosures. We have related party disclosures there. Related party disclosures. That is under public sector, under public sector. Then we go to the last number 6 is other reports, and emerging issues, in financial reporting. Other reports and emerging issues in financial reporting. Other reports and emerging issues in financial reporting. Here we have number one, conceptual framework, and the process of developing new standard, standards, conceptual framework and the process of developing new standard. Number two is integrated reporting. When you check on our notes, our first item is integrated reporting in our notes. Therefore, it is under other reports and emerging issues. Then number 3 here, we have global reporting initiative guidelines on sustainability reporting, This is pure theory, sustainability reporting. Global reporting initiative guidelines on sustainability reporting. Then number four, we have what we call management analysis commentary. Management commentary and analysis. Management commentary and analysis, it's pure theory. Then number five is legal and ethical issues. In financial reporting. Legal and ethical issues in financial reporting. Legal and ethical. This is pure theory. Therefore, we shall be looking at those theories. And when you check on our course out on our notes, already we have some notes there, like on the integrated reporting, global reporting initiative. We already have it. Therefore, make sure that you will be checking whatever we have covered, because we need to cover everything as per our course outline. We need to cover everything as our course outline. Therefore, as you can see, it's very wide. Therefore, we shall be going at some point with speed so that we cover everything. My good friend Waziri will post topic number 2 to our comrades. That is my good friend Waziri. Waziri, kindly you will share that. Thank you very much. Therefore, that becomes the end of our class today. Let's meet in our next session, that is on Friday from 7 p.m. Thank you. Have a good night.